I'm Grant Walker. Welcome to Last Call for Wednesday the 6th of May, and I'll be back Thursday morning at 10 with Heads Up. Business news. Delegate Group, New Zealand's largest listed wine company, has agreed to buy an 838-hectare farm in the Hawke's Bay for $29.3 million, extending its footprint in the region and lifting production from 2020. The Auckland-based company said in a statement the purchase of the farm in the Crownthorpe region of Hawke's Bay was settled in May 2016 and be funded from existing long-term bank facilities. The vendor is Hopkins Farming Group, a Manawatu-based company that owns about 4,700 hectares of property, comprising 11 dairy farms and 4 dry stock farms. Graham Lord, Delegate Managing Director, said the Crownthorpe region of Hawke's Bay produces world-class super premium wine grapes based on its ideal soil types and climate. The acquisition will enable Delegate Group to meet strong growth in global demand for its super premium wines, including Oyster Bay Pinot Gris and sparkling wine. Delegate intends to commence planting progressively from spring 2017, enabling incremental sales growth from calendar year 2020 onwards. He said the land, which is next to an existing Delegate vineyard, has the potential to produce more than 550,000 9-litre cases of wine a year when fully producing. At its first half results in February, Delegate said it was on target to achieve global case sales for the full year of 2.2 million, up 9% on last year, and to achieve operating net profit after tax of 34 million, also up 9%. It posted a record operating profit of 20.5 million in the first half, although net profit fell 45%, mainly caused by a $10.7 million write-down of its vines and grapes and losses on derivative instruments used to limit its foreign currency exposure. Delegate shares rose 1.9% to 484 and have gained 21% in the past 12 months. To the markets, petrol company Z Energy kicks off the May reporting season tomorrow, with analysts saying the level of discounting within the industry is something to keep an eye on. The market will already have a fair idea of what the result will entail, as dual-listed Z's fourth quarter operating stats were released last month, showing volumes remain flat compared to the same time last year. However, industry volumes are surging and Z's market share has fallen to 27%, compared with 28% from 3 months ago and 29% a year ago. Craig's Investment Partners analyst Grant Swanepoel told NBR Radio, the level of discounting in the industry is one area to keep a keen eye on when results are released on Thursday. New Zealand's fuel industry is an oligopoly dominated by Z, BP, Mobil or Exxon and Caltex or Chevron, with Gull also featuring in the Upper North Island market. Wellington-based Z was formerly Shell New Zealand before being sold to Infratil and the New Zealand Superannuation Fund in 2010 and rebranded before going public in 2013. Ministry of Business fourth quarter importer margins for petrol and diesel declined 12% and 10% respectively, and discounting remains aggressive. Mr. Swanepoel will be looking for commentary about the company's retail strategy since it opened and closed a number of stores in the past year, and has indicated new stores will be opened early in the 2016 financial year. The company was expected to keep close watch on US oil giant Chevron's plan to jettison $5 billion Australian worth of assets, which may include a sell-down of its shareholding in Caltex Australia. Mr. Swanepoel says in terms of sales, it's picked up quite nicely, but whether that's a reflection on the economy or what they've been doing in-house is unknown. Shareholders will be keeping a keen eye on capital structure and whether Z's going to be paying out more dividends than the current payout ratio. So what do analysts predict? Well, Craig's Investment Partners is forecasting earnings before interest, tax, depreciation, amortisation and fair value adjustments between 239 and 244 million. Forsyth Barr's forecasting EBITDA of 254. First New Zealand Capital is forecasting a strong result, picking EBITDA at 243, which is up more than 10% on last year's results. There are 22 companies releasing annual and interim results during May, with Diligent Board Member Services next to report on Tuesday and Trustpower 3 days after that.
NBR Radio, it's Wednesday the 6th. I'm John Stewart. State-owned coal miner Solid Energy is to announce further restructuring tomorrow. Hamish McNichol has been following that. He joins me now. So what's happening?
Basically, Labour's MP for the West Coast Tasman, Damien O'Connor, has come out and said that the company Solid Energy is going to meet its staff tomorrow afternoon and update them on restructuring plans. And he's got his fingers crossed that this isn't going to result in too many job losses. But he has also said that up to 400 people who still work there will be worrying about their jobs and waiting to hear about them. and that any losses will likely cause a shock to the West Coast communities. Last year, 185 jobs went at the Stockton mine, and at the time the company employed 521 people, and contractors employed a further 120. So perhaps not another blow that it can handle in that region.
So this restructuring is really no surprise?
No, back in March, which just a couple of months ago, the company foreshadowed that more redundancies at its Stockton mine, which is near Westport, were possible because of slumping global prices for coking coal. It's been talking to its banks about restructuring its borrowing, but Chief Executive Dan Clifford told Parliament's Finance and Expenditure Select Committee that plans were underway to stem these losses, and he said that reductions will be inevitable on the basis of those plans. Staff have been kept informed of these difficulties, and decisions were imminent, he said back in March.
Solid Energy's troubles have long been signalled, haven't they?
Yeah, so at the same Parliamentary Select Committee hearing, the acting Solid Energy chairman, Andy Coop, would not speculate on whether the company might fail, but he said there was a number of potential outcomes from discussions that it was having with its banks, and the fact that Solid Energy was not expecting any further support from the Crown. Finance Minister Bill English said at the time he wasn't sure whether Solid Energy remained commercially viable. Restructuring and cost-cutting has already reduced Solid Energy's break-even price for coking coal to between US $120 to $130 a tonne, but it's basing its plans for the year ahead on a price that it'll get of only about US $110 a tonne, so at least $10 below what the break-even price has to be for them. It's also said before that it's risks breaching its banking covenants in September next year. So while there's no immediate cash flow problems, they've certainly got to do something here.
So what's next then for Solid Energy?
Well, the government's already helped bail out Solid Energy in 2013, and then last year, just before the general election, it extended a $103 million indemnity to the company. So, I mean, as I said before, it's already the company has already said that it doesn't expect any further support from the Crown. So this meeting will go ahead tomorrow, and whilst we're not sure that job losses will happen, it looks like it's pretty clear that they will.
Hamish, thanks very much.
Thanks, John.
NBR Radio with the Property Press. It's out now to show you around.
NBR Radio, it's Wednesday the 6th. I'm John Stewart, and I'm joined by Nathan Smith with his Foreign Affairs scope. This week, I think, Nathan, you want to start with Texas.
Yeah. Texas, a couple of days ago, experienced what we'll be calling grassroots terror, essentially a gathering of Texans in Garland. We're talking about an illustration competition for drawing the Prophet Muhammad, and a couple of people did not like that and came in with guns, very amateurish. And were shot by security who were actually at the venue.
It wasn't the police who shot them; it was security.
It was private security, yeah.
Oh.
Which means that they were expecting some sort of retaliation potentially in that place, but they also had learnt from places like Charlie Hebdo or some of the other media organisations around in Europe that had experienced grassroots terror in the first place. So this sort of stuff has been talked about now for a number of years. That this is the reality that we have to expect. So gatherings like this are wise to have some sort of security around them.
Now, just looking to Europe, there have been fairly significant military exercises there.
Yeah, especially in the Nordic and the Baltic countries. Those two regions are closer to Europe and historically have had more ties with with Russia, and have historically had more ties with what Russia has been doing in its near abroad, and the concepts.
Those ties between the Baltic states and Russia are not necessarily willing ones, are they? It's
No.
a case of occupation, really.
Well, it's a case of proximity, and right. Being close. Finland, for instance, fought a war with Russia just less than 100 years ago. And it's not necessarily that they're feeling threatened, but Russia is being more belligerent these days. And there was a report a couple of days ago saying that I think it was the Swedish Navy, maybe the Norwegian Navy, dropped grenade-sized depth charges to scare away what they thought was an intruding submarine.
I think it was the Swedes.
Yeah. And that's just a part of the thread that we're seeing over the past maybe year or so of the Russians just pushing out the saber just a little bit more to see who it can poke and who it annoys and who it doesn't. They're also sending intercontinental bomber flights across the Atlantic through to the Arctic Circle as well, which is annoying the Yanks, of course, as it would. But it's also galvanizing those Nordic and Baltic countries as part of NATO to come together and think about what they're going to be doing about this Russian belligerency. And there's been some exercises this week, quite significant anti-submarine exercises, and it's just sending the message that push too far and you might get some pushback. Unsure what the NATO Charter would say about things like that, but necessarily these sorts of things have to happen because you have to send the message.
Indeed. Now, across the English Channel from Europe, we've got the British elections coming up, and indeed I think they're Thursday night our time.
Yes, that's right. So we'll be waiting actually I think it's Friday night our time, Thursday theirs, so that's the way. That's fine though. Looks like it'll be quite close, but the interesting thing about the British elections this time will be it will microcosm what's happening in Europe. UKIP are expected to get, which is the United Kingdom Independence Party, or used to be known as that, are suspected to get around 12 or 13% of the vote. The way the British do their voting is not necessarily on how many votes are cast for that particular party, but it's the representative seats that it wins, just similar to New Zealand's. And of course, every vote that UKIP get potentially take votes away from the Tories, which is David Cameron's, the incumbent Prime Minister's party. He may struggle in that case, which means it could open the doors for his larger rivals, the Labour Party, to actually potentially make gains, which he wasn't expecting. And it just sort of encapsulates Europe's problem at the moment, where although the EU is still a good structure, still seems to be fine in bringing people together and repelling others, it's repelling the people that potentially it doesn't want to repel. It wasn't built to repel. And it's galvanising others together that it potentially didn't want to see galvanised. So, for instance, the Scottish election last year, most pundits would have thought that it was a bit of a fizz. But still, to me and other analysts, 45% of people wishing that they didn't belong to the UK. That's an interesting stat in itself, and it tells us something about the gradual explosion of the United Kingdom's empire since 1945, and that's still going on, and there's still some balancing structures happening in there. But if you take what's going on inside the UK and take it, for instance, to Spain, where Catalonia isn't something that wants to be part of Madrid's control. And there are other places as well, like in Belgium with France. And there are pieces of Europe now thinking, do I want to be part of what I've been part of for a long time, or do I need to make some sort of independence move away from this? So what we're seeing in the UK is a more of a, how would I describe it, a rebalancing of the status quo. And that will bring some concern to Brussels and potentially Germany as well, which essentially controls the wallet of the EU. And it will also decide how the UK balances itself between the EU and the US as well. So the results of this election, more than most, although the UK is quite a small country and geographically and potentially weight around the world, more than most, this election will sort of push the boundaries of what we can expect from the EU crisis.
But just looking at the realpolitik, if you like, and the numbers, would UKIP, say it got 2 or 3 seats, be able to swing enough lead to force the UK out of the EU?
I think in the very long term, the phenomenon of both the Scottish independence movement and UKIP tell us all something about the way Europe is moving. I think it's the assumption is that the UK is a polity as as a block, and you can't have pieces of it moving off in different directions. And so these people, like the Scottish Independence Movement and UKIP, both sound like crazy people because they're not going with the status quo, which is UK is one block. But that's going to become less and less crazy in the future as more countries around that EU area start to talk in the same ways: anti-EU, anti-immigration, anti-coordination. And that's... So they might sound crazy now, but in the future they may not, and they may pull power back because of that reality as everyone else starts to change the narrative.
Now, let's just head to the Middle East and Syria. The rebels have actually managed to gain some territory.
Yeah, some analysts are pointing to it being quite a significant tranche of territory that they've taken. In the Idlib province, which is in the sort of the centre northwest of the country, that has, for the past 2 years or so, been a pretty solid area of control by the regime forces, and that's Bashar al-Assad's. And so taking pieces of that back now appears that they're pushing the Assad forces back quite significantly. I would suggest looking at it in a slight different way. Assad's forces have a problem with manpower, but not necessarily a problem with materiel yet. And so what they've tried to do is know that they can't control the whole of the country, so they have withdrawn troops from around the country to certain key strategic points. And those strategic points run in literally an arc from Damascus all the way through to Latakia in the northwest. And that whole province there is basically the Assad's core. Those are the Alawites, which he comes from ideologically and ethnically. And if he can maintain the support of that particular crescent, then he maintains control over that particular part. I would consider Assad not the president of Syria, but simply the strongest warlord. But if he can control this area, then he can stay in some sort of coherent force. So pulling back from Idlib a little bit strategically makes sense in this sort of context.
Finally, and just very briefly, these rebels that have gained the territory, they have no connection with ISIS?
So that's an interesting problem with the Syrian battle, is that there is no rebel force. There are multiple rebel forces, and as you just pointed out, one of them is ISIS. Another is also Al-Qaeda affiliated, known as Jabhat al-Nusra, and then there are others that are also jihadist. The Free Syrian Army is probably the most... shall we say, supported by foreign entities like the US and the EU, but they're one of the smallest, and they've needed to lean on Jabhat al-Nusra to help with some strikes, especially in the south, which means that right now most people's cohering narrative here is let's get rid of Assad. What happens after that is anybody's game. But right now, they're all kind of fighting together, and I use scare quotes. You can't see them, but I do use scare. They're fighting together for common benefit right now. And, of course, the other enemy is ISIS as well. But that doesn't mean that will always be the case. There is no rebel force, so to speak.
Well, Nathan Smith, thanks very much for this week's Foreign Affairs Scope.
NBR Radio. Free to air online. NBR, the meeting place of intelligent business.
To the latest on wages, New Zealand wage inflation slowed in the first 3 months of the year as an expanding labour market soaked up growing capacity, helping lift participation to a new record. The labour cost index shows private sector wages rose 0.3% in the first quarter, slowing from a 0.5% pace in December, according to Statistics New Zealand. That's the slowest pace since the March 2014 quarter. Annual wage inflation for the private sector was unchanged at 1.8%. Including the public sector, total labour costs rose 0.3% in the quarter, slowing from 0.5% 3 months earlier for an annual increase at 1.7%. The Reserve Bank last week said it was monitoring wage and price-setting outcomes after consumer price inflation fell short of its expectations, prompting Governor Graham Wheeler to adopt a bias towards lowering interest rates. The New Zealand dollar dropped to 74.91 US after today's data from 75.54 immediately before, as traders speculated weak wage pressures would add to the case for an interest rate cut. The TWI declined to 77.51. Just 11% of all salary ordinary time wage rates increased in the quarter, the lowest proportion since March 2010, in what's typically a muted period for pay rises. On an annual basis, 59% of salaries were hiked, unchanged from the December period. The quarterly employment survey showed ordinary private sector wages rose 0.2% to an hourly rate of $26.83, the slowest quarterly growth since the December 2012 period. Including the public sector, ordinary time wage growth was flat at $28.77. New Zealand's unemployment rate was unchanged at a revised 5.8%, higher than the expected 5.5% forecast in a Reuters survey of economists. The number of people employed rose 0.7% in the quarter, while the participation rate increased 0.2 of a percentage point to 69.6%, a new record. Auckland led jobs growth in the quarter, though an increased workforce lifted its unemployment rate to 6.9% from 5.8% in December, while Canterbury's jobless rate fell to 3.2% from 3.5%. Northland had the highest unemployment rate across the country at 9.9%, up from 8.3% in the December quarter. Apartment conversions versus office space. Auckland City fringe office vacancy rates are dropping sharply through a combination of companies wanting more upmarket space and significant refurbishment and conversion projects. The latest Bailey's research shows vacancies have fallen to 13.7%, down from 16.8% last year and a high of 16.9% in 2011, when the impact of the global financial crisis and New Zealand's recession was at its peak. Declining vacancies have been led by more companies moving into higher quality offices. Empty space in A-grade offices has dropped to just below 7% from 13.8% at the beginning of last year. A number of significant leases have been signed by tenants such as BP New Zealand and Lottery New Zealand. The companies have moved into the new Watercare Services building in Newmarket. Bailey says the fall in city fringe vacancies has come despite there being only 8,397 square metres leased in the last year, moving this figure into negative territory. This reflects the reduction in office space as an increasing number of buildings are either being refurbished or converted into apartments, according to research manager Ian Little. Mr. Little says B-grade space dropped by more than 1.5 percentage points to 14%, and C-grade vacancies fell by 2 percentage points to 20.1%. Residential conversion of secondary space is gaining momentum, according to Mr. Little. More than 18,000 square metres is being taken out of available office space through Tawera Group's conversion of 15 Hopetoun and 8 Hereford Streets into apartments. Hereford Street was previously leased by Telecom and Auckland Council as anchor tenants and has room for 115 apartments, while Baycorp House at Hopetoun Street will be converted into 91 apartments. Empty office space fell in 4 of the 5 city fringe locations monitored by Bailey's. Only Parnell bucked the trend with a marginal increase from 12.9% to 13.1%. College Hill fell from 7.6% to 5.1%, showing the least amount of empty available space, while Grafton fell from 19% to 15.6%, Newmarket fell from 18.9% to 14%, and Newton from 20.5% to 19.2%. Mr. Little says vacancies declining in the more upmarket offices is in line with similar trends in the CBD. He says because the next wave of development is not off the drawing board, the total amount of office space will not increase significantly over the short term. He says further conversion remains likely, pulling vacant space out of the market. Mr. Little says with the New Zealand economy tipped to grow solidly throughout the rest of the year, it's certain there will be further tightening of the market across all grades of property. He says this is likely to increase rents at the upper end of the market.
NBR Radio, Wednesday the 6th. I'm John Stewart. I'm joined by business reporter Callida Smiley. Callida, you've been following the release of a survey of chief financial officers. Can you tell us about it?
Well, Deloitte just released this survey yesterday, and it's showing that New Zealand CFOs are significantly less enthusiastic about their financial prospects than they were this time last year. And when I talked to Deloitte partner Peter Gulliver, he told me that it's possibly because of they're taking a cautious approach to the rebound overseas around economics.
Right. So are there any specific opinions from people included in this survey?
There are, but when I talked to Peter Gulliver, he was saying that, CFOs, they usually take a look at the domestic conditions, which are looking fairly good, although the growth is centred in Auckland and Christchurch. And so companies that have businesses outside of these places won't be seeing as much growth. And he also says that they're worried about the economics overseas. I mean, there's things like growth is slowing in China, and Australia is facing difficulties. There's still some issues around European debt, and there's some falling commodity prices. So these CFOs have to keep all these things in mind when they're making risk judgments.
Well, the survey also looks at setting risk appetite. What does that mean, and what did Deloitte think of that particular result from the CFOs?
Well, actually, it threw up a surprising result, and that was that more than 40% of CFOs saw it was management and not the board that was setting the risk appetite. And Mr. Gulliver thought that was quite surprising because it's something that Deloitte would see would be the primary responsibility of the board. And he was saying it might reflect the size of the organisation, so the larger organisations have a experienced board in place that would be doing this, but the smaller organisations would be, the management would be taking more control. And there's also a bit of a wedge between management and board's perception of risk. So, 22% of CFOs were saying that the board and management views were pretty different when it comes to risk. And when I was talking to Mr. Gulliver, he was saying, while healthy debate is a good thing, that sort of level of divergence shows there needs to be a bit more talk between the two.
Callida, thanks very much for that.
NBR Radio. With Clooney Restaurant now offering Auckland's most exclusive private dining room. NBR Radio.
Back to dairy prices. Weak global dairy prices have prompted analysts to pull back their expectations for Fonterra Cooperative Group's payout to farmers for next season. Average prices dropped 3.5% in the GDT auction overnight. New Zealand's key product, whole milk powder, slipped an average 1.8%, extending its cumulative decline over the past 5 auctions to 27%. Auckland-based Fonterra last week cut its forecast payout for the current 2014-15 season to $4.50 per kilogram of milk solids from a previous forecast of $4.70 and, of course, last year's record $8.40, citing an oversupply in international markets and volatile commodity prices. Fonterra is expected to pay farmers between $5.50 and $5.75 for the upcoming 2015-16 season, according to a Business Desk survey of 5 analysts, 2 of whom reduced their forecasts following last night's GDT auction. The forecasts have come back from a month ago when Fonterra was expected to pay between $5.75 and $6.20 for the upcoming season. The co-op is expected to publish its forecast for next season following its May 27 board meeting. Global dairy prices have slumped amid higher production and weaker demand. Fears that drought conditions in New Zealand could crimp milk supply proved unfounded, with Fonterra now expecting production this season to lift 1.5% from last season, from a previous forecast that it could fall 3.3%. Meanwhile, demand is weak, particularly in China, the world's biggest importer of dairy products, with New Zealand whole milk powder exports to China in March less than half what they were a year ago. ASB Bank rural economist Nathan Penny said the challenge for dairy prices at present is supply has proved to be relatively strong while demand has proved slow to recover. Dairy prices, he says, are low and staying there a while longer. We expect prices to remain low over the next 2 to 3 months before finally beginning their lift. ASB's Mr. Penny cut his forecast for next season to $5.70 from a previous expectation of $6.20. In the latest GDT auction, longer-dated milk powder contracts flattened relative to shorter-dated deliveries, suggesting the dairy price recovery will remain gradual. He says attempts to stimulate the Chinese economy will bear fruit, but it will take time. Meanwhile, lower prices should discourage farmers from increasing production, particularly for those who won't break even at the current $4.50 price. He said we continue to expect dairy prices to recover from the current low levels, but increasingly we expect that recovery to come later, with prices remaining muted over the next couple of months. With recovery expected to now be that much later in 2015-16, the season's overall outlook is now lower. Dairy products are New Zealand's largest commodity export group, and the dairy sector generates more than 7% of the country's GDP. To politics and state houses. Labour's housing spokesman Phil Twyford says the government's sale of a further 1,600 state houses will do nothing to fix the housing crisis or improve tenants' lives. National has announced it's selling the properties in Tauranga and Invercargill as part of its program to get out of state housing. They'll be sold to registered community housing providers, according to a media statement signed by Ministers Bill English and Paula Bennett. Mr English cites efficiencies as a reason for the sell-off, but he does not identify any of the housing providers who are lining up to buy the properties. In January, Prime Minister John Key announced the government would transfer up to 2,000 state houses to community providers this year. The recent transfer of 2,800 state houses to a Tamaki housing provider included a government $200 million loan to help with working capital. The next step is to consult with iwi and hapu in the two regions to identify any interests under the Treaty of Waitangi before deciding whether to proceed to market sounding. Mr Twyford says selling state houses won't make them more livable. He says the government has no evidence to support their claim that social housing providers can do a better job of managing state houses than Housing New Zealand.
NBR Radio. It's Wednesday the 6th. I'm John Stewart. I'm joined by Jason Walls, who's been examining the reasons behind our low inflation. Jason, who have you been talking to?
Yeah, good afternoon, John. I've been talking to a couple of people about this. In fact, a university lecturer from AUT reached out to me to tell me some of his perspectives on New Zealand's low inflation rate, and his name is Satine Kumar. And we have been having a bit of a chat. It started with an email conversation, and it kind of eventuated into a little bit more of a look at New Zealand's inflation rate. And what he's saying is there is a mismatch of beliefs between the Reserve Bank and the New Zealand populace. And he's conveying that essentially a lot of people within New Zealand don't know what the Reserve Bank is up to, and this can have bad impacts on things like inflation. This isn't just reserved to just average people. He was saying that it's actually firms as well, and he tells me that it's managers and directors of firms. In a lot of cases, he was telling me that people didn't know what New Zealand's inflation rate was, and the people that did know said that inflation rate was between 5 and 10%. So that's quite a way away from what actually in New Zealand
certainly is.
Yeah. So we had a chat about that, and he was basically conveying that he came up with some research he'd done with a few colleagues, and it's just in examining this misinformation around macroeconomic information.
What sort of misinformation is he talking about?
Well, it's just to do with the idea that people don't really know either what the Reserve... Well, they know what the Reserve Bank does, but when it gets down to a more granular level and some of the more specific things, people are a little bit more... They don't really know as much. It's something that you would understand.
So presumably it's affecting their ability to do business plans.
Well, I mean... It's sort of what he's saying. He's saying that just since they don't know, it's just having this impact on the level of inflation. And then, however, I talked to another economist from New Zealand Institute of Economic Research, Dr. Lee, and he was actually telling me the exact opposite thing. He was saying, although there are some economic models that do incorporate people's expectations, there are quite a few that don't. And it's actually quite beneficial to the Reserve Bank at some point to have people not to have expectations not taken into account.
Thanks for that, Jason.
NBR. Need to hire? Try our online recruitment platform, www.nbrtalent.co.nz.
To the ERA, a leading employment lawyer says the facilitation process ANZ and First Union are about to embark on is a robust process. After 10 months and 8 rounds of collective bargaining, the ERA has ruled the industrial dispute over pay and casualisation can go to facilitation. Anthony Harper lawyer Jennifer Mills says there have been fewer than 30 cases moved to facilitation in the ERA's history, including the high-profile Ports of Auckland dispute and a case she recently took for Refining New Zealand. Ms Mills says in her case, the Refining New Zealand case, the facilitation brought parties together, and although parties had reached an impasse, the ERA member was able to break it. The lawyer's sentiment matches a majority of NBR member subscribers in a recent poll who say facilitating is worthwhile if parties are acting in good faith. However, 43% say it's a waste of time. Ms Mills says the difference between mediation and facilitation is that facilitators, unlike mediators, have the power to make recommendations and publish them if necessary. She said there's that stick hanging behind it which makes it better than mediation. ANZ and First Union begin facilitation next month. So just what do CFOs think? Well, New Zealand's chief financial officers are significantly less enthusiastic about their company's financial prospects now than they were last year, which may be a reflection of overseas economic trends. A recent Deloitte survey of 133 CFOs from a range of business sizes, industries and locations shows 46% are somewhat more optimistic or significantly more optimistic about their company's financial prospects compared to 3 months before. But this is significantly down from 58% in 2014, although still up from 37% in 2013. Those in charge of the purse strings are more worried about higher than normal levels of external financial and economic uncertainty, with 45% of CFOs saying they were concerned, up from 36% last year, although down from 64% in 2013. Only half believe the time is right for taking greater risk onto their balance sheets. Deloitte audit partner Peter Gulliver told NBR Radio that CFO's cautious attitude may be driven by the rebound in macroeconomic uncertainty. He said CFOs have usually got one eye on the domestic economic conditions, which by and large are pretty positive, and one eye on the international situation where there are more headwinds. He says there's slowdown in growth from our second largest trading partner China, and our largest trading partner Australia is also facing difficulties. Our dollar against the Australian dollar is really high, which won't be helping exports. Lingering issues with European debt and falling commodity prices also mean CFOs are less exuberant than last year. Domestically, interest rates and unemployment levels are low, but growth is mainly focused in Auckland and Christchurch. Mr. Gulliver says the regions are not benefiting from these economic conditions to the same extent, so businesses with exposure to these areas are a bit more cautious. So it would depend on where the CFO's company does business as to how they're seeing the domestic growth story.
NBR Radio, it's Wednesday the 6th, and I'm John Stewart. I'm joined by our political editor, Rob Hosking, in Wellington. Rob, Judith Collins on the way to a path to redemption?
Well, it's starting to look that way. She's never been slow at spotting a political opportunity, and the whole ponytail saga has been an opportunity for her. She was, of course, Women's Affairs Minister for a while. In fact, I can still remember her calling Grant Robertson a big girl's blouse in the House during a debate on Women's Affairs which is an unusual thing for a Minister for Women's Affairs to call anybody, but, that's Judith Collins, I guess. She's very much, she's one of the big beasts of the political jungle. She does have a certain following, and they're very loyal to her. And the inquiry into her conduct around the leaking of information to or about the Serious Fraud Office Chief Executive Adam Feely to the whale oil blogger, did clear her. Somewhat surprisingly, many people thought, but it did clear her. So she's sitting there and I suppose audibly starting to tap her foot. Wondering about when she's going to be readmitted to Cabinet, or at least to a ministerial portfolio, even if it's outside Cabinet.
Well, she's got quite a large contingent of supporters, but she's also got a large contingent of enemies. Where are they? Just in the opposition or her own party?
Quite a lot in her own party, I suspect. The opposition party's kind of... it's very odd, but... the people who talk most about her being a future national leader tend to be Labour Party people. And the only explanation I can come up for that, apart from, political parties, MPs and activists, they always talk about leadership problems in the other party. That's part of the game of politics. Why seize on Collins? Well, two reasons. One is she does want the job. She tends to sort of certainly leave you that impression. But secondly, I think Labour, she reminds them of Jenny Shipley, who's a woman and sort of from that wing, if you like, of the National Party.
But she's also got, has she not also got some competition in the form of Paula Bennett, who seems to be, yes, if not anointed, partly anointed or on the way to it?
Yeah, I think Bennett is a much more likely one if there's going to be a change in the next few years. But I do think it's some way off. Unless Key decides, screw this stuff, I'm out of here. I don't think there's going to be any leadership change for a while. And that's the other thing, of course, that Collins has to, any speculation about Collins' future leadership has to deal with. the longer Key stays there, the lesser chances are anyway. Now, personally, I've never rated, although it's been quite clear she wants the job, I've never rated her chances particularly highly. I think she's too divisive, both within the party and more widely. I can't see her having a great deal of popular appeal outside. She does have a very, as you say, a very, very loyal fan base, but that's a long way from being a majority, and she tends to be quite divisive.
Well, thanks for that insight, Rob.
Join NBR's Intelligent Business Network today. www.nbr.co.nz/subscribe. NBR.
I'm Grant Walker with Last Call. Here's what's trending on NBR Online. What CFOs really think. The job market surges. Reaction as the government sells off more state housing. Delegates buys more land for grapes, but where? Briscoes and Countdown showing good results, and the mega listing falls through. To find out more, log on to nbr.co.nz or stay tuned. Those stories coming up next on NBR Radio.
NBR Radio, Wednesday the 6th, I'm John Stewart. The British election on Thursday night, New Zealand time, looks set to produce no clear result. The Conservatives and Labour both have a third each of the popular vote, leaving it to other parties to decide the next government. In his editor's insight on Wednesday, Neville Gibson looks at what's likely to happen. Neville, the British still use the first-past-the-post system, but are producing an MMP-style result.
That's right, John. The British are following a lot of other countries that use proportional representation, and that signals an end to majoritarian governments. Not that they have changed the system there, it's just that it's producing the same sort of results. Of course, we're used to the MMP system that gives the smaller parties a much larger say. In Britain, the small parties still have to win an electorate, but the rise of these identity groups are called by political scientists, be they have racial or nationalistic objectives or even environmental like the Greens, they're really breaking away from the dominant umbrella parties. And the polls, since we last talked about this about a month ago, the polls show absolutely no change.
Well, looking north of the border to Scotland, there's been quite a turnaround. What sort of turnaround?
Yes, well, Scotland, which is what we focused on in the last discussion, that hasn't changed. They've swept the board there in the polls. It looks like they're going...
This is the Scottish Nationalists.
That's the Nationalist Party. They've got a very charismatic leader, Nicola Sturgeon, and she's done very well in the election campaign. And she could be entering the House of Commons with all 59 seats, mainly taken from Labour. The Tories haven't won a seat there in the past two elections. But when you look at the SNP, it's a pretty radical party. It doesn't look like it really wants to be a coalition partner. And New Zealanders all know this from their MMP experience, that you do need to have a certain amount of compromise going there. It's very antagonistic towards the Conservatives, which rather closes off the options. And the Labour Party, of course, not very happy that they've stolen all their votes, say, well, we're going to find them hard to deal with as well.
If you look at the poll results for the Tories, what has David Cameron's government done wrong?
Well, very little in many ways. Britain's going through quite an economic revival at the moment, but these have been driven by austerity measures taken over the past 3 or 4 years, and obviously they're not very popular. You've had a Conservative Liberal Democrat coalition with the Liberal Democrats losing quite a bit of support. There have been cuts to welfare entitlements, like there's a bedroom tax on those who've got spare bedrooms in state houses there. That's been pretty unpopular. But the Tories haven't been completely heartless. They've reduced the income tax threshold for those on low wages. They've raised the minimum wage, and the economy has delivered something like 2 million new jobs, and first home buyers have received some assistance. Of course, house prices in England have been going up quite substantially, if not throughout the whole of the UK.
Well, that begs the question, where have the Conservatives lost support if they've been so generous?
Well, we go back to the MMP solution. A lot of those votes have gone to a new party that's really done quite a run of the UK Independence Party. It's got 12% of the public support, which is just a little bit ahead of the Liberal Democrats, but the UKIP, as it's known, is fighting the election mainly on disaffected middle classes. They say they haven't been getting the kind of incomes and the flow on from a better economy, but mostly their focus is on anti-immigration policies, particularly from the European Union. In fact, UKIP want the UK to leave the European Union. This has divided the Tory side of the political fence, but certainly not the left. Labour are still pretty pro-Europe, so the Liberal Democrats, and oddly enough, so are the Scottish. They see being in Europe possibly is more important than staying in the UK.
So, Neville, what will happen if both major parties end with the same number of seats but not enough for a majority?
Well, if Labour don't become the government and the result is indecisive, David Cameron will stay in power as a caretaker. He'll probably try to cobble together a coalition, but if that goes on for too long, Labour could turn to legal manoeuvres and tip him out in a no-confidence vote. That's because they passed, when they set up the coalition at the last election, a fixed-term Parliaments Act, which was to prevent any fragmentation. A second election will only follow if there's a specific vote of no confidence or if two-thirds of MPs vote for an election.
What will the election mean for British business and the economy?
Well, the commentators, depending on whether you're left or right, say that the UK is poised to take two different paths under Labour, with SNP having quite a big say. It'll be higher taxes, that's in their policies, more government borrowing, and perhaps quite a kick in extra growth over the next 5 years, according to one calculation of 0.6. The alternative, which is mainly probably from the right, they say the status quo will keep reducing the government borrowing need down to for the next 3 or 4 years, and then growth will pick up even stronger. Other analysis say that it could be pretty even, but obviously that's where whether you politically support higher taxes and government spending, or you think you're going to get a better result by doing the opposite.
Neville, thanks very much for your editor's insight.
NBR Radio with Bayleys, New Zealand's leading commercial real estate company.
I'm Grant Walker. Welcome to Last Call for Wednesday the 6th of May, and I'll be back Thursday morning at 10 with Heads Up. To Solid Energy. Labour MP Damien O'Connor says state-owned coal miner Solid Energy is to announce further restructuring tomorrow, possibly including job losses, which will be a shock for the West Coast. In March, the company foreshadowed more redundancies at its Stockton mine near Westport because of slumping global prices for coking coal. It was talking to its banks to restructure its borrowing. Chief Executive Dan Clifford told Parliament's Finance and Expenditure Select Committee plans were underway to stem the losses and reductions will be inevitable on the basis of those plans. Mr Clifford said staff were being kept informed of the company's difficulties and decisions are not a matter of days or of double-digit months. Now, Labour's MP for West Coast Tasman, Damien O'Connor, says he has his fingers crossed any job losses will be minimal. The company is to meet staff tomorrow to update them on restructuring plans. Mr O'Connor told TV3 up to 400 people will be waiting to hear about their jobs, with any losses likely to cause a shock to the West Coast communities. Mr O'Connor says now the reality of a slump in the coal price will hit the miners, as it has too often throughout history. The West Coast will survive as it has in the past, but the immediate impact on many young local families will be devastating, he said. In March, acting Solid Energy Chairman Andy Coop would not speculate on whether the company might fail, but said there were a number of potential outcomes from current discussions with its banking consortium and that Solid Energy was expecting no further support from the Crown. Finance Minister Bill English questioned whether Solid Energy remained commercially viable. Restructuring and cost-cutting had reduced Solid Energy's break-even price for coking coal to between $120 to $130 a tonne, but it was basing its plans on a price in the year ahead of $110 a tonne. Solid Energy has also said it risks breaching its banking covenants in September 2016. Mr Coop said there were no immediate cash flow problems, but it was unlikely to be enough to overcome the September 2016 issues. He said, "My view is that we cannot see the refinancing of our debt facilities as realistic absent a restructure of our liabilities." The government helped bail out Solid Energy in 2013 and also extended a $103 million indemnity to the company just before the general election last year. To the fishing industry, the Māori Affairs Select Committee has been told recommendations to restructure Te Auhu Kai Moana, giving iwi full control of Aotearoa fisheries, may be rejected by Māori interests over concerns about vigilance and managing diverse interests in the sector. The 2015 independent review of the Maori fisheries settlement by Wellington barrister Tim Castle recommends that Te Ohu Kaimoana, which oversees Aotearoa Fisheries and its $543 million in fishery assets, be wound down, with power returned to iwi groups for management. Under the Maori Fisheries Act in 2004, Te Ohu Kaimoana was set up to manage the fishing quota awarded to Maori in the 1992 fisheries settlement. Te Ohu Kaimoana owns all of Aotearoa Fisheries' voting shares and 20% of its income shares, with the remainder spread across all iwi. The review recommends the trust be wound down and distribute its shares to iwi, which Mr Castle says was the intent of the 2004 legislation and establishment of the trust in the first place. Mr Castle told the Māori Affairs Select Committee, iwi are now mature and capable to take control of their destiny. Iwi are ready for direct control. Te Ohu Kaimoana's Chief Executive, Peter Douglas, and Chairman Matthew Ray said the recommendations are still being presented to iwi, with an appointed iwi working group seeking views on the proposed changes to the structure. A special meeting for iwi to decide will be held on June 4, but Douglas and Ray couldn't predict whether the recommendations would be accepted on. Douglas said there was concern that the vigilance the body has over the industry may be lost, and it was a question of how to maintain a voice across the recreational, commercial and customary fishery interests. The recommendations would give iwi control over Aotearoa Fisheries, which owns Moana Pacific Fisheries, Pacific Marine Farms, Prepared Foods and half of Sealord Group. It also recommends the trustees of both Te Pūtea Whakatupu Trust, which runs Māori education initiatives, training and research, and Te Wai Māori Trust, which funds research and development in freshwater fishery initiatives, become stand entities with their own administrative support.
NBR Radio, it's Wednesday the 6th, and I'm John Stewart, and I'm joined by Nick Grant, who's going to tell us that the long-delayed NZX listing for Mega has fallen over. What was the original plan for this listing, Nick?
Well, John, originally the listing deadline had been set at June 30 last year, and the way it was going to work, it was going to be what's called a backdoor listing, whereby a Auckland-based company, TRS, which is listed on the NZX, would buy 100% of Mega for $210 million. And that would be satisfied by the issue of 700 million new shares in TRS to the existing Mega shareholders at 30 cents apiece. Now, TRS would also undertake a 148-for-1 consolidation of its existing share capital, which would leave Mega shareholders owning 99% of TRS, which would then adopt the name Mega. And thus, Mega would, through this backdoor mechanism, if you like, affect the listing on NZX. Now that deal has been delayed by my count 6 times since the original 30th of June deadline of last year. My understanding is because in terms of getting the paperwork done through the NZX, there have been delays, and there's been a backwards and forth between Mega and NZX.
So delay really is the main reason for this falling over?
I'm currently working on a deal to try and get to the bottom of what's actually happened, because according to the market update that has been released today, it looks like Mega shareholders have put the kibosh on the deal. TRS had been advised overnight by Mega that the shareholders would not agree to an extension of the conditional date. My understanding of all these delays, however, has been that there is no documentation has not been presented to the TRS shareholders for them to approve the deal, and I can't see any indication that that paperwork has actually been provided to TRS shareholders, who, from all accounts, were very eager to sign off on it. So there are a lot of interesting questions around why the kibosh has been put on it.
Thanks for that explanation, Nick.
You're listening to NBR Radio. Upgrade to My NBR Radio with a smartphone-only subscription to NBR Online today for free, and receive unlimited access to NBR Online on your smartphone until August 31st. Visit www.nbr.co.nz/free.
Business news. Briscoe Group increased first quarter sales and margins across its homeware and sporting goods retail chains and said profit is tracking ahead of the same period last year in a highly competitive market with relentless promotional activity. Sales rose 4.3% to $119.8 million in the first quarter, ended April 26, Auckland-based Briscoe said in a statement. Excluding the opening of 2 new Rebel sports stores in Paraparaumu in December and Christchurch in March, sales rose 3.4%. Briscoe's homeware and sporting goods chains both increased gross profit percentages compared with the same quarter last year. The retailer is boosting profits after enhancing its inventory management, introducing new store technology to manage stock, improving marketing, refining the quality and breadth of its product ranges, and improving store layouts. It said it's also benefiting from foreign exchange cover taken out last year when the New Zealand dollar was significantly stronger against the US. Managing Director Rod Duke said Briscoe Group has made a very positive start to the current financial year. Increased sales and margin performance across both homeware and sporting goods has resulted in group profit tracking ahead of last year. First quarter homeware sales increased 0.5% to $73.1 million from the year earlier period. Its sporting goods sales increased 11% to $46.7 million. Excluding the impact of the 2 new store openings, sporting goods sales increased 8.4%. Briscoe Group is expected to increase annual profit by 5.4% to $41.4 million as sales rise 5.6% to $535.4 million, according to analyst estimates compiled by Reuters. The company's shares last traded at $2.90, having slipped 2.4% so far this year. The stock is rated an average hold, according to 3 recommendations compiled by Reuters. Employment news. Soaring migration levels and low price inflation are keeping wage pressures low while participation rate and hours work continue to climb. Unemployment remains sticky at 5.8%, the same level as the previous quarter, but the labour force participation rate is at 69.6% of the population, the highest since the Household Labour Force Survey began in 1986. Among the batch of labour market data released by Statistics New Zealand this morning, perhaps the most important is the hours worked. These grew 2.7% for the year to March, coming off the annual peak of a 4.6% increase to March last year, but still sizable. In terms of the actual number of hours, growth has been something of a tear since 2013. Behind this are some big shifts in the labour market. The number of jobs grew by 73,000 year on year to March. The combination of a swelling labour force and low price inflation means wage inflation is also lower than expected, 0.3% for the quarter instead of an average market forecast of 0.4%. That takes the labour costs index, which measures the increase in the costs to employers, to 1.7% for the year. The data was softer, to use the jargon, than some were expecting. The average market forecast was for a 5.5% rather than 5.8% unemployment figure, as well as slightly higher labour cost rises. That could tilt the Reserve Bank closer to the interest rate cut Governor Graham Wheeler suggested is now, for the first time since the Canterbury earthquakes in early 2011, being seriously considered. Price inflation remains low, and the Consumer Price Index measure of inflation will almost definitely dip into deflation in the next quarter. The strength in the hours worked, however, points to continued solid economic growth. In market news, First New Zealand Capital Securities, the research firm and broking house, has been publicly censured and fined $15,000 by the New Zealand Markets Disciplinary Tribunal after trying to fix up a trading error without informing the market operator. The Stock Markets Disciplinary Tribunal found First New Zealand breached stock market rules by failing to notify NZX immediately of an error that had a market impact, it said in a statement. The broking firm's decision not to inform the stock market operator meant NZX wasn't able to take the appropriate regulatory response and was aggravated by First New Zealand's attempts to rectify the problem itself. The tribunal said in its decision, the practice of market participants taking matters into their own hands has the potential to impact on market integrity and bring both the market and NZX into disrepute. The penalty is intended to send a clear message that self-correction of errors by market participants is unacceptable. Policymakers are trying to restore public confidence in capital markets, introducing a raft of legislation in recent years aimed at improving disclosure, making it easier for retail investors to understand offer documents, and beefing up oversight of financial markets and penalties for egregious misconduct. First New Zealand's error arose from one of its clients placing an order on July 28, 2014 through the broker's direct market access system to sell 8,194 shares in an issuer on the main board at market price, which was stopped by the system's filter to prevent trades that would cause a movement of more than 3% in the last traded price. The order was redirected to a trading desk and manually put through by a dealer, resulting in 6 trades of 4,788 shares being executed at 5 different price levels and prompting a decline in the share price to $2.70 from $3.13. The broking house then cancelled the outstanding portion of the order and subsequently placed 4 buy orders, one of which was with a pre-existing client for 1,000 shares at $3.15. On August 1, 2014, First New Zealand then deleted the 3 remaining buy orders it had placed, leaving them unfulfilled, and subsequently confirmed in later correspondence with NZX that its dealer had clicked through the full order to market by mistake. NZX submitted the broker breached rules by failing to notify it immediately of the error and because it failed to ensure its conduct helped promote and maintain an orderly market. That the error was unintentional and no clients were adversely affected was seen as mitigating factors, though NZX submitted the broker's attempt to remedy the error and similar breaches in 2012 were claimed to be aggravating factors. First New Zealand disagreed with the view that the previous breaches were an aggravating factor, but admitted the mistake and accepted the penalty. The tribunal accepted First New Zealand's submission that mistakes happen, but said it was concerned the broking firm didn't have adequate systems in place to manage errors appropriately. It said the tribunal also considers FNZ needs to address its systems for dealing with orders that are caught by DMA filters.
NBR Radio with Hotel de Brett. Open for breakfast, lunch and dinner and everything in between. NBR Radio.
Business news. Countdown, the New Zealand supermarket chain owned by Australian retailer Woolworths, lifted third quarter sales by 5% as it eked out bigger volumes in a low inflation environment. The Sydney-based parent said sales rose to $1.5 billion in the 13 weeks ended April 5 from $1.43 billion a year earlier. In Australian dollar terms, sales rose 7.7% to $1.43 billion Australian as the company benefited from a weaker currency during the period, increasing the value of offshore exported earnings. Year-to-date sales rose 2.4% to $4.55 billion. Woolworths said our price drop and price lockdown campaigns continue to resonate well with customers, driving improved price perception results as well as growth in customer numbers and units sold. The Countdown Supermarkets Food Price Index for the quarter was deflation of 0.1%, with deflation continuing across the major key categories including grocery, meat and bakery. New Zealand food prices have been subdued over the past year as globally low inflation keeps price increases muted. Government figures show grocery food prices rose at an annual pace of 0.5% in March. Countdown opened 5 new stores in the first 6 months of the current financial year, refurbished 3 and closed 2, taking its total store numbers to 174. It expects to open a net 6 new stores over the full year, ahead of its long-term target of 3 to 5 stores a year. The supermarket chain didn't open any new stores in the last quarter and refurbished 1 existing outlet. Woolworths reported a 1.6% decline in third quarter sales to 14.96 billion Australian and has targeted its Australian food and liquor division after disappointing sales in December and January. The company today announced plans to strip out $500 million of costs over the 2015-16 financial years, focused on its non-customer-facing operations. Woolworths will also restructure its Australian and New Zealand supermarkets into one division, which it anticipates will deliver savings across the combined operation. The ASX-listed shares fell 4% to 28.44 Australian. In construction news, quality control systems on the huge Waterview Connection project helped identify faulty concrete delivered by Firth. A section of Ramp 4 on the Great North Road interchange will have to be repaired, and some retaining walls, footpaths and crash barriers have also been affected. The planned opening in early 2017 will not be affected, however. Firth, a subsidiary of Fletcher Building, delivered faulty concrete to commercial and residential projects late last month and then stopped production at one of its plants while the problem was sorted out. The projects range from backyard paths and post holes to commercial projects. Firth General Manager Andrew Moss says clients were told the same day the issue was discovered. He says faulty measuring equipment is to blame and isolated to one production plant. Each site where the faulty concrete was delivered has been visited by Firth to assess remedial action on a case-by-case basis. Mr Moss says in half the cases no action is needed, while concrete will be replaced where necessary. He says each site has a stringent quality control daily testing program, and it was through this that Firth discovered the substandard concrete. The plant with the faulty testing equipment has since been reopened. In listing news, a deal for an NZX listing for Mega, the cloud-based file storage and encryption firm launched by internet entrepreneur Kim.com in 2013 to replace his Mega Upload empire, has fallen through because of delays in gaining approval from the listed shell company TRS Investments. Auckland-based TRS, controlled by interests associated with Australian investor Paul Choiselat, has repeatedly extended its deadline for the Mega deal, with the latest deadline for shareholder approval set at May 29. TRS said in a statement, it has become evident that this condition will not be satisfied within this time frame. TRS has been advised overnight by Mega that the shareholders of Mega will not agree to an extension of the conditional date. As a result, the share sale deed entered into between TRS and the Mega shareholders will terminate, and the proposed acquisition of Mega will not proceed. TRS said it's now considering its obligations to issue new shares to Mega as payment for meeting TRS's transaction costs. The board of TRS are very disappointed with this development and will be looking at other investment opportunities for TRS as a matter of urgency, they say. Under the deal, TRS was to have acquired Mega for $210 million by issuing 700 million shares at 30 cents apiece to Mega shareholders after undertaking a share consolidation. Mega shareholders would then have owned 99% of TRS, which would change its name to Mega. Mega Upload was frozen after .com's high-profile arrest at the behest of the US federal government, and he since stepped back from the new Mega, which has more than 15 million registered customers in more than 200 countries, according to a statement in March. Earlier this year, PayPal stopped processing payments for Mega after NetNames, a US group with funding from the Motion Pictures Association of America, claimed it was among companies whose services were not legitimate or legally compliant. TRS shares last traded at 0.3 cents, valuing the company at $3.3 million. Mega's largest shareholder is a company owned by Zhao Shen of Auckland, with about 26%, according to the company's office. Another company owned by Jesse Guy, also of Auckland, holds just under 16%. Wolf Ortmann of Germany owns 15.6%, and .com's estranged wife Mona.com holds 15.5%.
NBR Radio. Free to air online with business news you can use.
Let's talk venture capital. New Zealand's institutional venture capital community is still recovering from the global financial crisis 6.5 years ago, although so-called angel investors are in better heart, according to a visiting venture capitalist from Silicon Valley. Palo Alto, California-based Garage Technology Ventures managing director Bill Reichart told Business Desk the local venture capital community isn't at critical mass and is still recovering from the GFC. In contrast, he says the angel investor sector appears to be vibrant, although it would benefit from greater pooling of resources. He said, my impression is the institutional venture capital community is still not recovered from the meltdown, and that just put a huge dent into building the institutional venture capital community. Nevertheless, he says there seems to be a very vibrant angel community here. Last year, Angel Association Chairman Marcel van den Assem urged his fellow investors to broaden their portfolios rather than backing one or two firms in the hope of a big payoff. Garage Technology Ventures Reichert said the question for New Zealand angel investors was whether there was enough collaboration in the investing community. He said in a situation like this, there should be more pooling of resources and focusing of attention around the most likely success stories. He said the whole nature of the market economy says let 1,000 flowers bloom, but if you don't have enough water and you let 1,000 flowers bloom, most of them will die. Adiba Bani, Chief Executive of SV Forum, a Silicon Valley non-profit organisation aiming to foster the high-tech region's ecosystem, said New Zealand's entrepreneurs and early-stage startups need a champion to help create an environment where they interact with each other to develop a thriving community that feeds off each other. She's optimistic the local scene has found that in government agency Callaghan Innovation, which had been tasked with helping fund the road to commercialisation by subsidising research and development and supporting a group of incubator programs, she says creating those kinds of opportunities are really important. That's why what Callaghan Innovation are doing is very, very important, much more so than you'd imagine. When it's too spread out and you don't have someone bringing it all together and being the champion for it, it makes it harder. Reichardt, who is a beachhead advisor for New Zealand Trade and Enterprise in North America, said the reality for most New Zealand entrepreneurs is that when they want to go global, they will have to leave the country to do so. Reichardt and Barney are travelling to New Zealand's main centres, meeting entrepreneurs, investors and business leaders to help support Callaghan's incubator program and provide local businesses with a connection in Silicon Valley. In trading news, the volume and value of cash trading on New Zealand's share market declined last month. According to Wellington-based NZX and its monthly shareholder metrics, the total number of trades fell 12% to 97,392 in April from the same month a year earlier, while the total value dropped 12% to $2.6 billion. The daily average number of trades slipped 12% to 5,126, while the daily average value slipped 12% to $138 million. The number of equity trades slipped 13% to just under 95,000, while the value slipped 13% to $2.5 billion. In the debt market, total trades rose 6.2% to 2,406, while the value increased 70% to $108 million. The value of NZX's equity market climbed 13% to $102.2 billion, or 48.8% of GDP. The number of listed equity securities increased 3.6% to 172 from the year earlier. The value of NZX's debt market slipped 9.1% to $12.6 billion, or 6% of GDP. The number of listed debt securities fell 5.8% to 81 from the year earlier. Issuers raised $53 million of capital across 22 events in April, taking the capital raise so far this year to $752 million. Shares of NZX last traded at $1.15 and have shed 1.7% so far this year.
NBR Radio, it's Wednesday the 6th, and I'm John Stewart. I'm joined by our political editor, Rob Hosking in Wellington. Rob, some new labour market figures out today. Can you tell us more?
Yeah, this is the they put all the labour market data out in one hit now. So we got the three surveys of the household labour force, which is the main employment and unemployment one. The labour costs index, which measures wage inflation, basically, increases or decreases or whatever in the costs of hiring people to employers, and the quarterly employment survey, which is more specifically aimed at employees. So it doesn't include self-employed or very small businesses. And look, as with a lot of these things, it's often a bit of a pick and mix. The phrase economists are using is this is a little bit softer than what was expected. Most people were expecting unemployment to drop a little bit, and it hasn't dropped at all. It stayed at 5.8%.
So it's been pretty stubborn, isn't it?
Yes. And some of this is driven by, we've got that record high net migration figures we're having, because the size of the labour force has grown quite a bit. And we've got 73,000 new jobs in the last year. And, that's quite a sizable amount of growth, and certainly the hours worked, which includes full and part-time, is still climbing quite steeply. So that basically says, look, the underlying picture is of an economy that's growing reasonably strongly. If hours worked are pushing up quite that sort of level, but the size of our labour market is growing quite strongly as well, and that's basically, to simplify it a little bit, that's why unemployment hasn't shifted. But the other thing is there's a skills story starting to come through here too, because one of the things that's happened in the last 5 years is New Zealand businesses have been on a bit of an investment binge as far as plant machinery and other sorts of equipment goes, capital equipment, which is going to boost their productivity. And it's for 20 years, it's been a long-standing worry that New Zealand firms weren't investing enough in long-term capital investment, things like plant machinery and IT and things like that. But the combination of low interest rates and a strong dollar in particular means the imports of these things are quite a lot lower, the cost of imports. And so there has been a bit of an investment binge going on. But what that in turn means, you've got as demand for what our firms do picks up, what that in turn means, you need more skilled people to operate, more complicated equipment. I'm really simplifying here, but this is the principle, right?
Sure.
So that means that a lot, and we do have a very poor skills base in New Zealand, and so that I suspect is driving a lot of the migration, as well as more Kiwis staying home because the picture offshore is less rosy, which in turn means that those lower skilled people aren't getting the jobs, and I very strongly suspect that when we drill into the data a little bit more, and people will be doing that over the next few weeks, particularly within some of the government policy agencies, we're going to find that it's very much that low skills based story.
Political editor Rob Hosking, thank you very much.
NBR. With a National Business Review smartphone subscription, you can read or listen to the latest from NBR online. And for a limited time, it's free. Join NBR's Intelligent Business Network today and get free smartphone access to NBR online until August 31st. NBR doesn't do sport, weather or horoscopes, just timely, relevant, useful and insightful business news. So for business news you can use for free, visit nbr.co.nz/free.